Welcome back to Squawk Box. Rick Santelli here, live on CME HQ with the breaking news of the morning. The cousin to CPI, we have the wholesale version, PPI, for October. Headline number expected up 0.2. Once again, delivers up 0.2. In the rearview mirror, it was zero unchanged. Zero unchanged would have been, we had 4 of those in 2024 thus far. Popping up 0.2 equals where we were in August. Find a higher number, you go to June when it was up 0.3. If you strip out food and energy, up 0.3, hotter than expected, hotter than the rearview mirror, up 0.3. That's the warmest since it was up 0.5 in June, equals where we were in August. Now, if we strip out food, energy, and trade, also hotter than expected, up 0.3, in the rearview mirror, up 0.1, hottest since July when it was up 0.4. Now, let's take a step back and do a year over year, a bigger view. 2.4 expected, 2.3 expected, 2.4 warmer than expected. In the rearview mirror, 1.9, which was 1.8. 2.4 is the third highest reading of the year. To find a higher, you go to June, 2.9. Now, if we strip out food and energy on a year-over-year basis, expected 3%, rear view mirror 2.8, comes in at 3.5. 3.5, that is, 3.1. 3.1, and that is hotter than expected. Strip out food, energy, and trade, that's 3.5. 3.5 is the warmest, going all the way back to March of last year. Now, these numbers are definitely warmer. If you look at initial claims, 217,000, that is 4,000 less than 221, which was last week, unrevised. 217 would be the lightest going back to May of 24. And finally, on continuing claims, they remain above 1.8 million, coming in darn close to expectations, 1,873,000, following a slightly revised 1,884,000. We see that yields have picked up a bit. I'm a little surprised, actually, that they haven't picked up more, considering, let's see, 1, 2, 3, 4, 5. Pretty much every single number is hotter than the rearview mirror, and every single number outside of the headline up 0.2 is higher than expected. We've seen 2-year note yields move from 4.26 to 4.29, basically unchanged-ish. And we see 10-year note yields went from 4.43 to 4.45. 4.45 is also unchanged-ish. We're hovering very near the lowest closing yield since the first couple of days in July in a 10-year. And maybe the biggest story of late, outside of the big run in equities post-election, is the re-steepening of the yield curve and how the market seems to keep short rates like 2-year notes more in line with Fed expectations, which was evident yesterday in CPI, versus the long end, which seems to be paying attention to a variety of other issues. Becky, back to you.
Okay, Rick, thank you. For more on the data, we want to bring in Jerome Schneider. He's head of short-term portfolio management at PIMCO. Also, our very own Steve Liesman. And Steve, you go first. Tell us what else you're seeing in those numbers. Steve?
Yeah, something going on in demand for transportation and warehousing services. Not exactly sure what's going on there, whether or not, I don't know if that was strike-related or something going on there. But that was a pretty big bump right there. Not sure if that was the reason. I had, according to my estimate, the ex-food energy in line with expectations. Didn't change the number, which was 0.3, but the Dow Jones forecast was for 0.3% on the ex-food energy. Look, this is definitely a bump hotter than expected in terms of the overall direction of things. Maybe you make it, it's in line or a little bit hotter on the month, but I think we're going through a bump here, not really sure. Most folks that I've read in terms of yesterday's CPI expect November to do better because of certain one-off things they think, like, for example, airline passengers yesterday. And Rick is exactly right. Guys, if you could put up,
better,
I don't think you put
lower.
them up together, but, sorry?
Better meaning lower inflation, right?
Better meaning lower, yes, in terms of next month. If you could put up charts of the 2-year yesterday and the 10-year, I want to visually show you what Rick was talking about. So you see the 2-year yield, I guess it's up this morning. Yesterday it fell and stayed down, while the 10-year went down and came back up, and that's why you did get that 8 basis point increase. Very interesting. I think Rick's got it exactly right. The 2 follows the Fed. The 10 has a lot of other things on its mind.
Very quickly, a little hotter than maybe anticipated in some ways of looking at it, Steve, but you don't think this is something that would call the Fed off from the expected cut in December?
Well, no, because they get another round of inflation reports in November before the next meeting.
Yeah, okay.
And before the November meeting. So there's reasons to think that
December.
The airline passenger thing, some other things in there, we'll see if they all net out. There were a few things that were down. The used car thing was a big issue. The 2.7% increase in used cars was a reason. People were like, well, that's not exactly what's going on. Also, the rent number is expected to come down. I don't know. I don't want to make like I'm looking at only the things that were higher than normal and saying, well, let's get rid of those things. But most of the economists I've read say they think things are going to improve in November before the next meeting. And it is also the way the market is betting. Now, I will say, Kugler this morning, maybe a little on the hawkish side. You had Barkin earlier this week said, hey, equal outcomes. Inflation could be stuck or it could improve. So we are getting a little bit of hawkish commentary from the Federal Reserve. The market continues to bet, and I will just check this number here. I had an 80% number before this number, and it's still up 77%, down a little bit. Yeah. Anyway, still a pretty big bet in the market. The Fed cuts in December.